Okay, here we go. This is for accounting 230, 66633, financial accounting class, chapter 11 on stocks. So let me get the PowerPoint going here. Share the PowerPoint. Let's see, share. Okay, I assume that you can see that. And we're going to get going with chapter 11 here. Okay, we're going to talk about stockholders' equity. We're going to talk about what a corporation looks like. We're going to talk about common stock, preferred stock, and treasury stock. We're going to talk about cash dividends, stock dividends, and stock splits, and how stockholders' equity is reported and analyzed. So here we go. Corporation. You can classify them by purpose, meaning profit, for-profit, or non-profit. For-profit would be Facebook, IBM, anybody who starts a business to try to make a profit. Non-profit would be a charity. It would be something like the Salvation Army, American Cancer Society. It's a hospital, it's a school. It's the Santa Barbara neighborhood clinics in town here where I worked for a number of years. So you can break them up by profit, non-profit, or publicly or privately held. Facebook, IBM, Caterpillar. The big companies you see on the stock market are publicly held. People went out and bought stock and got a proportionate ownership of the company. A company like Cargill never issues shares to the public. Management owns all of the shares. A corporation has some advantages. It's separate legal existence. It limits your liability. Unlike a sole proprietorship or partnership, you're only going to be limited to the amount of your investment in terms of a loss. Easy to transfer the rights. You're able to raise money. So characteristics of a corporation. A disadvantage is corporations pay a lot more in different types of taxes. You got to worry about government regulations. And you got to manage the place. Let's take a look at an organization chart. And this is very typical. You have stockholders at the top of the food chain. They're the ones who make all the decisions, theoretically. They're the ones who hire the chairman of the board and the board of directors. The board of directors is the group that hires the president or chief executive officer, and that person then sets up his or her paradigm here. You could have a legal department here, marketing, finance, operations, resources. Notice that the financial officer is broken down into two different characteristics. One is the controller. The controller is the one doing the actual accounting for the company. The accounts payable, receivable, the inventory, the analyses, the reports, projections. The treasurer is the treasurer limits himself to borrowing money on behalf of the company, finding investments for the company. He doesn't take part in operations at all. How do you form a corporation? You file with the Secretary of State, you get a charter, and you come up with your bylaws, and off you go. That's basically it. Stockholder rights. Stockholders can vote in the election of the board of directors and on any other actions that require their approval. And while you're holding the stock, you may be lucky enough to receive checks in the mail known as dividends. Stockholders' rights. And the last thing is, if the place goes out of business, shareholders will collect money as long as there's enough to pay them at the end. But stockholders are way at the end of that food chain here. Stockholders don't get paid until lenders get paid. So that's one of the disadvantages. And here's an example of a stock certificate. They're old-fashioned. This one says 100. If you read it, it says 100 shares, Franklin Life Insurance Company. And it'll have the par value on this thing and some all other good information. It's just a little tough to read. Now let's talk about authorized stock. Authorized shares are those shares that you as a company are allowed to sell. It's limited by the state. The number of authorized shares is often reported in the equity section as a note. Okay, you have 1 million shares. You're authorized to sell. That's the most you can sell. Now you start issuing shares. You issued 900,000. That goes directly to the people buying the stock. That's what a stock issue is. Company says we're open for business, we're selling stock, and you, the public, decide whether or not you want to buy that stock. Stocks will typically have what's called a par value. Par value is a meaningless number. It has nothing to do with the value of the stock. If someone says you have a choice of a stock with 1 penny par value or one with $100 par value, there's no difference. Those stocks have no difference at all. The penny one could be a much bigger deal. The only thing you're going to do with the par value is multiply it by the outstanding shares. That's the only thing you ever do with it. Which of these statements is false? Legal capital is intended to protect stockholders. No, it's to protect the company. Indicate whether each of the following is true or false. Let's just go over this a little bit. Corporations, similar to partners in a partnership. As soon as you hear that, you know it's false. It's easy to obtain capital. Yeah, easier. The separation of owner and management is an advantage, not particularly. The journal entry to record the authorization of capital stock. As soon as you see journal entry authorization, you know it's false. There's no such journal entry. And all states require a par value. Not true. Some states sometimes let you get away without a par value. So let's look at our stockholders' equity section here. We have corporate capital. Here's your stockholders' equity section. And we have 2 pieces, paid in capital. This is monies that have been paid into the business to get it going. We might have gotten some common stock issues, preferred stock issues, and to the difference between what monies we actually collected minus the par value, which is a meaningless number, that goes into a capital account called paid in capital. Paid in capital in excess of par. And then the second piece is retained earnings, okay? Retained earnings, that's how much money this company has made over its history, minus dividends. Retained earnings is net income that a company keeps for future use. And they're just showing you're closing out retained earnings. And there's a real simple, truncated balance sheet section. Paid in capital comes first, right? Common stock, retained earnings, 130, 930 total. Owner's capital, common stock and preferred stock, and retained earnings all have normal credit balances. We should know that by now. Doral has 750,000 of common stock and net income of 122. Well, at the end of its first year, they had $750,000 of shares that they issued, and they made a profit of 122. So look what that did. That increased the stockholders' equity by that $122,000 at month end. Let's talk about different types of stock. Common stock, preferred stock, treasury stock. Common stock. If you called a broker today at your age and said you have maybe $1,000 that you can spare and you're interested in opening up a brokerage account, that stockbroker will be glad to take your money because he or she is looking forward to 50 years of your business. Okay? But what that broker is going to assume is you're buying common stock. That's what most people buy if they're looking for a capital gain investment. Common stock. Other than consideration received, the issuance of common stock affects only paid in capital. Let's make that a little more clear here. Hydroslide issues 1,000 shares of $1 par value stock for $1. Well, that's not going to happen, but they're just showing you what happened if it would. You debit cash, you credit common stock. Notice what happens, though, in the more realistic scenario where you got $5 a share for your shares. The common stock line is still 1,000. because all you do with the par value is multiply it by the outstanding shares, and that becomes your line on the financial statements. The difference goes into a capital account called paid in capital in excess of par. And here they're elongating the equity statement, not the equity statement, but the balance sheet stockholders' equity section a little bit. Common stock 2,000, paid in capital 4,000. We now have 6,000 paid in capital, plus a profit apparently of $27,000. All right. Now let's talk about preferred stock. Preferred stock is a completely different animal than common stock. They have nothing to share in terms of their characteristics. On a preferred stock, the par value is actually important. Okay, the preferred stock might say $100 par value, and then it'll say 6%. It'll actually have a percentage on it. In that case, that means that that stock is going to pay $6 a share dividend if you pay dividends, if the company chooses to pay dividends. The company does not have to pay dividends ever, even to the preferred people who are kind of expecting them. Preferred stockholders are not allowed to vote in the way that the common stock people do. If the company liquidated, preferred stock people would get paid before the common. And before common stock people get even 1 penny in dividend, preferred people get paid first. That's what you call preferred stock. Preferred stock dividends are paid, and only then do the common stockholders get the chance to look at a dividend. Okay. And the accounting is exactly the same thing. Issued shares for $12 a share, brought in $120,000 in cash. Preferred stock, again, you take the par value times the outstanding shares. There's your 100,000, and the difference is capital. Capital. It's called paid in capital in excess of par value. And that's just another one there. So now we're back to our little grid here. And notice we have something else on here now. We just went through common stock, preferred stock, and the paid in capitals and retained earnings, which we already know. Now we're going to talk about something called treasury stock. Treasury stock. It's the company's own stock that they reacquired. In other words, you have a corporation and you issued 100,000 shares to the public. You may want to buy back your own stock. And if you do, you just have to buy it the same way you and I do. You have to go to the market, whatever the market is, and purchase the stock back. Companies do this for different reasons. One reason is if they think the stock is undervalued. They'll say, we have a good product. We have good people here. This stock is trading at 50, it really should be at 80. And so you take a chance. You buy the stock off the market at 50 and you hold it and see if you can sell it back for additional capital. Also, treasury stock is bought to pay stock dividends to some of the big shots. And that's not good for the other shareholders, okay? Accounting for treasury stock, use the cost method. Take a look at this now. We're buying back some shares of stock. The stock has a par value of 5. But after a while, the market went up, the price of the stock went up to 8. We decided we want to buy 4,000 shares of our own stock. We debit treasury stock and we credit cash, okay? Treasury stock is a contra equity account, so that when you purchase treasury stock, you are actually reducing your equity. Now, how can that be? We're buying stock, you know, that shouldn't affect us. It certainly does, and it affects you with a reduction of capital, because you can't buy your own stock and then put it on the balance sheet as if it's an investment. That would be a terrible conflict of interest, could lead to fraud, and it's forbidden. You cannot make a profit, show a profit on buying and selling your own stock. You can do it, but you can't do it to show a profit, okay? And we'll talk a little bit about that as we get going here. So here is your extra long balance sheet section. We start again with paid in capital, always starts with the paid in capitals, retained earnings, and then you subtract the treasury stock. Treasury stock. When you buy treasury stock, your capital goes down. Okay. Here is a purchase of treasury stock at I guess it's at par value was 50, and they bought it at 60. 3,000 times 60 is $180,000. Okay. Debit treasury stock, contra. It's a contra equity account. You credit cash. Let's talk about stock dividends, cash dividends, stock splits. Dividends are a distribution of cash or stock to stockholders on a pro rata basis. Companies will announce that we're going to pay $2 a share dividend this year. Well, when they do that, we're going to look at the following things. Before you can issue a dividend, you have to have sufficient retained earnings, adequate cash, and the most important thing, a declaration of dividends by the board of directors. The board of directors decides if we're going to give a dividend out, when we're going to give it out, and how much. So there are 3 dates you need to understand for the test. You have 3 dates. Declaration date. That means that the day the dividend is declared or announced, it creates a liability. You are going to debit retained earnings because all dividends reduce capital, as you would probably figure, because you're giving part of the company away. So you debit retained earnings and you credit dividends payable. And that's what we're looking at here, dividends payable. The second date is the record date. All that means is that's the date in time, the point in time where we get the list of people who own the stock on that day. They're the ones who get it. If you bought the stock at the end of the 21st, you got the dividend the next day, and then you sold the stock a day later, you got the dividend, okay? And then the payment date, very simple, debit the liability, credit cash, okay? Cash dividends. Entries for cash dividends are recorded on what 2 dates? The declaration date and the payment date, not the record date. Now we're going to talk about some dividend preferences. Here we're getting into the preferred shares. Remember we said that preferred stockholders get paid before the common stock? That's absolutely true. And also, most preferred stocks have what's called a cumulative feature. It means that if the stock was supposed to pay a dividend of $100 in 2019 and it didn't do it, and it didn't do it in 2020, well, then when they get to 2021, that company has to pay not has to, but they will pay 3 years worth of preferred dividends. There's no such thing as cumulative common stock. It doesn't work that way. So let's see what we have here. Scientific Leasing has 5,000 shares, 7%, $100 par value. That's $7 per share, okay? And they're going to pay a $7 dividend. So 7 times 5,000 is 35,000. Would you agree? That is the amount of the annual dividend. But they're telling you that the annual dividend is 35, but dividends are 2 years in arrears. So the preferred shareholders, if they have the cumulative feature, are entitled to receive 3 years worth of dividends. Okay? Cumulative preferred stock. Preferred stock is not an investment. I'm never going to recommend anything, but preferred stocks are bought by people who are looking for income and not capital growth. If you have a company and they invent a brand new product, the common stock could go through the roof, could go way up, and you could sell it, make capital gains. Preferred stock isn't going to go anywhere, because the only thing the preferred stock is going to do is pay you your 7% here. That's all you're going to get out of it. I'm skipping that question because I thought it was wrong when I saw it before. Okay, let's take a look here. 2,000 shares outstanding, 6%, $100 par value. That's $6 a share. The stock now is non-cumulative. Non-cumulative. That means that if the company skips a year, they don't have to pay it. They're only going to pay the current year. So with that in mind, the company has $60,000 to spread around for dividends. We pay the preferred people first, they get 12, and the balance of that would go to the common shareholders. And this is the same type of problem here, 2,000 shares, this time it's 6%. They declared $60,000 cash dividends, and the preferred stock is cumulative again, and they're working with 3 years. So 3 years times 2,000 shares times 6%, or $6 a share, times $100 gives you 36,000. 60 minus 36 gives you 24 available to common shareholders. Let's talk about stock dividends. Stock dividends. The company doesn't have the cash or doesn't want to give out the cash in terms of a cash dividend. They could do something else, though, that you might like. They may say to you, you have a share of stock. You have 100 shares of stock, and that stock sells for $60 a share. We're going to give you a 100% stock dividend. What that means is instead of having 100 shares times 60, you now have 200 shares by 30. Nothing has changed in how much the value of your stock is. It's just that the price of the stock has been cut in half, but your shares were doubled to offset it. And companies do this when the stock price starts getting real high and small investors start getting fearful of it. It's psychological. When Apple went up to like 1,800, it finally split, I believe, something like 7-1. If you owned Apple stock when it was at, say, 1,400, and they split 7-1, well, you didn't own one share at 1,400 anymore. You own 7 shares at 200. And what that do is makes the stock a little more marketable. It's, again, psychological. The public says, oh, Apple's got the price of the stock down. It's time to buy. You have 2 different types of dividends, large and small. Know that there are large and small dividends. The difference is with a small dividend, you're going to run the difference between the par value and the dividend against paid-in capital. Stock dividend, just a 2-line entry. I don't know if that's going to be much on your homework or test. Maybe I'll double check, and if so, I can go into it a lot more than that. But let's look at the impacts. Here is your stock dividend. Before the stock dividend, there was $500,000 of common stock. Okay, we give out a stock dividend. There's now $550,000 out there. The paid-in capital stayed the same. Okay, retained earnings though went down by the 25. Went down by 75. Okay, it was 100,000. What they're not showing you here is $100,000 market price at that time, and they issued 25 above that. The difference is to 75 here. The outstanding shares went from 50 to 55. Notice that the par value didn't change. So a stock dividend is nice. You know, you might get a 3-for-1. You get 3 shares for every one you have. I used to get stock dividends where I worked for many years, and I always thought they were great, even though they really don't affect anything. They hopefully have an effect, though, in the short term. A stock split. If you own 100 shares of stock and you got a letter in the mail that says, got good news for you, that 100 shares of stock at $50 a share, well, you now have 200 shares at 25. You are not going to care whether that was the result of a stock dividend or a stock split. As far as accounting goes, you don't do anything with a stock split. Nothing is done with a stock split accounting-wise. To simplify it, the only thing that happens with a stock split is the board of directors vote to change the par value. That's all. So everything is the same at the end. You're still going to have the same amount of stockholders' equity. Okay, it's just that the outstanding shares have doubled, and the par value was cut in half. And they're just demonstrating a stock split or a stock dividend. You have 4 shares. There was a 4-for-1 split. So now you have not 4, but 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16 shares at 1/4 of the price. A stock dividend has no impact on total stockholders' equity. Let's understand that, nor does a stock split. Here, Singh Corporation, they're giving you some information to work with. Here's the original balances, and the common stock has tripled from 15 to 45. So Joan Elber is considering a 10% stock dividend or a 2-for-1 stock split. So let's see where this takes us. Takes us out of the it takes us out of the chapter. What you would find, though, if it was a 50, say she offered a 10% stock dividend, that would be 50,000 times 15. That would be $750,000. You would see 750,000 reducing retained earnings and increasing paid-in capital. Everything would be the same. How do we report it? As we know, net income increases net earnings, and loss would do the opposite. Retained earnings is part of stockholders' equity. If you have a debit balance in retained earnings, we call that a deficit. That means you're losing money. And they're just showing you how you might put that in there. Retained earnings, like I said before, you have to have enough money to pay your dividends. You have to have a certain amount of retained earnings available. Balance sheet presentation of stockholders' equity. There we go. Now let's take a look at the final balance sheet. Stockholders' equity, paid-in capital. You start with common stock. It says capital stock. Okay, capital stock. That's okay. Capital stock. Preferred shares go first. To give you an explanation, $600,000. Common stock. Common stock. This thing is stuck for a second. Common stock, 2 million. You add it up, you get 2,000,006. The paid-in capital, as you probably understand now, is the difference between how much you received from the market on the issue and what the value was, not what the par value was. So you have a couple elements here. You have what they're calling capital stock is preferred stock. I don't know why they're using the term capital stock. I don't think I've ever heard that before. So preferred stock, 2,000,006. Common stock. Oh, I see. They're mixing them together. Okay, that's fine. Your total paid-in capital is right here. You add retained earnings and you subtract the treasury stock. You subtract the treasury stock. And they're just asking you to prepare a stockholders' equity section. And again, you divide and conquer. You start with capital stock, starting with the preferred, then comes the common, and then comes the additional paid-in capital, retained earnings, treasury stock. Those are your 5 pieces. Preferred stock, common stock, paid-in capital, preferred, common, retained earnings, treasury stock. Let's make it even easier. The elements are stock, paid-in capital, retained earnings, and treasury stock, reducing it. Let's look at a couple of ratios that we're interested in. Here, we're going to take the net income, and then we're going to take the cash dividends declared on the common stock. We're going to take the cash dividends declared on common stock. We ignore the preferred stock because the payment on the common stock is less discretionary. So we take the dividends declared on common stock and we divide into it the net income. And here we get 26.7. We'll call it 27 cents. 27 cents. That means that for every dollar of income, this company is giving back to its shareholders 27 cents. That may be good, that may be bad, depending on the paradigm. Let's look at another metric called return on equity. Here, we're going to take the net income, subtract the preferred dividends for the same reason we did before, and we're going to divide it by the average common stock equity, which is the average of the beginning and ending balances for the year. And here we're coming up with a number of 34.4%. That's 34 cents. It means that for every dollar of equity, this company gives away 34 cents out of their heart for dividends. And these are metrics investors look at and they want to know about. If this number is too high, it might not be sustainable, might not be as good an investment as you think. And again, they're talking debt versus equity. Debt versus equity here, okay? Okay, here's the income before we talk about whether we're going to finance with debt or equity. If we finance with debt, we're going to have to borrow $5 million, right? But at least the $600,000, 12% times 5 million is 600,000. That $600,000, at least those payments are tax deductible. So we get a tax break. If we then consider income taxes, we're going to end up paying more in income taxes if we issued the stock than if we issued the bonds. So if you issue bonds in this scenario, you're going to have a better return on common stockholders' equity. But don't think companies automatically issue with bonds. You may not want to take on the debt. Remember, there's disadvantages with bonds. You have to pay back the interest. You have to pay back the principal, okay? An advantage of bonds is you don't lose control of the company. You're not giving away the company. With stock, they gave away, with the stock, they gave away whatever it was going to be, maybe $5 million. That is now no longer under company control, but by the public market. So issue stock, issue bonds, you get a tax break on bonds, okay? Analyzing it, compute the return on stockholders' equity for each year. And they don't do it for us, huh? But I think we know it's pretty easy. We're going to take the net income, subtract the dividends on preferred stock and common stock, and we're going to divide it by the average equity, which you see right there, okay? Prepare entry for stock dividends. Well, this is what the dividend looks like. You're going to debit stock dividends. Stock dividends is retained earnings. As far as I'm concerned, we should call that retained earnings. You debit stock dividends, aka retained earnings, and you credit the common stock amount at par, and you then have the paid in capital effect. So that takes us up to the international world, which I don't do in my lectures, and that'll be the end of it. I hope this helps you. I'm sorry for the darkness here. I tried to do this at school earlier today, and I did my spiel for about 45 minutes and found out I didn't turn the recording button on. So hopefully we've done that here. Otherwise, I'm going to be pretty miffed. So anyway, good night, everybody. You know where to find me.